Good morning, Big Square Road.com with your morning horn of Z's, your sip of coffee. My editing skills have gotten better and faster. I have posted the part 2 of the Cliff High interview on Patreon and on the private road. Go check it out. Amazing stuff. Talks about the sci-fi world, secret technologies, quantum Mandela effect. Deep subjects. It's really cool. So go to Patreon or private road to check that out. What I want to talk about today is cryptos and the concept that cryptos will absorb the liquidity of the derivative market. That I hear some of my friends saying, I hear it out there, and the concept that of a revaluation and all this stuff that's thrown around. Total and complete misunderstanding of what's happening. Total and complete. I know there's great people out there in cryptos working for a smooth transition, but they don't even understand what a derivative market is. That's the problem. Cryptos cannot absorb the derivative market. I don't even know who started that. It sounds like some tech guy, thinking he's done well in Bitcoin, said, "Hey, we can make this good. So let's say that the cryptos can absorb the derivative market." That's a ridiculous comment. Ridiculous. And I'll show you why. First of all, crypto's down across the board. Nothing normal. Nothing unusual. Again, all cryptos run off computer programs. Click of a mouse, Steve Mnuchin can drive them to zero or drive them to 1,000,000. The idea, the concept of the reason for holding cryptos is for the end of the manipulation, and that is coming. And I'll tell you how that is coming, because Alan Greenspan implanted a nuclear bomb in the financial system by making sure that derivatives were unregulated in the late 1990s. Huge controversy in the late 1990s. Look up Sheila Bair. And she won the Kennedy Award for Courage in Government or something to that effect. She fought against Greenspan and Summers and Rubin. I've talked about it a few times. But the Greenspan's idea was, hey, I tried to crash the market with computers in 87. It didn't work. I tried to crash it in the savings and loan debacle in the 90s. It didn't work. I tried to crash it in the dot-com bubble. It didn't work. I tried to crash it in the 2008 derivative, hint, derivative issue. Wasn't big enough. How big does it have to be to destroy the criminal old system? It has to be the biggest, the mother of all biggest, in the quadrillions. And that's exactly what has been triggered. No, crypto people, you don't understand derivatives if you think that the cryptocurrencies are going to soak up derivatives and have some kind of a smooth landing. It cannot happen. It will not happen. It should not happen. If it was able to happen, everything would be the same. It would just be in the crypto derivative / asset. You cannot move the multi-trillion dollar, quadrillion dollar derivative market. The vast majority is traded OTC, over the counter, not on exchanges. And they're very complex contracts. They're not like, hey, I'll give you an ounce of gold in 6 weeks and you pay me this money and then that's done. No, these are very specific contracts with all kinds of variables and requirements and credit exposures. And it is an absolute nightmare, and it was designed to be that way. The crypto people that think that cryptos will absorb the derivatives are delusional. Let's talk about what a derivative is. Derivatives, their risks and rewards. Great article came out a little while ago in February. A derivative is a financial contract that derives its value from an underlying asset. Most people will just stop there. Most people's concept of derivatives just stop there. That's something that's a side bet. It derives its value from an underlying asset. But keep going. The buyer agrees to purchase the asset on a specific date at a specific price. So there's two counterparties already. You got two credits that are involved too. You have to know the value of each credit, and they have to stay in business for that derivative to actually work. Derivatives are often used for commodities such as oil, gas, and gold. Other asset classes is currency such as the US dollar. There are derivatives based on stocks and bonds, still others on interest rates, such as the 10-year treasury note. Absolutely. It is everything. Financial has been derivatized on purpose to implode the entire system. The contract seller doesn't have to own the underlying. No, this is a great article when you read behind the words. The contract seller doesn't have to own the underlying asset. He can fulfill the contract by giving the buyer enough money to buy the asset at the prevailing price. Again, this is the basic derivative world. So you're looking at two credits. Doesn't have to have the asset, but what if silver goes to $1 million an ounce, and all of a sudden JP Morgan owns $50 trillion? You have two credits, you got a lack of money on one side, that means this side isn't going to get their other end of the contract. He can also give the buyer another derivative contract that offsets the value of the first. This makes derivatives much easier to trade than the asset itself. That's classic. Let's hear that again. He can fulfill the contract by giving the buyer enough money to buy the asset at a prevailing price. He can also give the buyer another derivative contract that offsets the value of the first. This makes derivatives much easier to trade than the asset itself. So what you're doing is adding a third party. You're saying, I got another derivative over here that's going to counterbalance this derivative. So all of a sudden you have 3 credits and 4 credits and 5 credits and a zillion credits. And each credit is weaker than the next as it goes down the chain. More about derivatives. In 2017, 25 billion derivative contracts were traded. 25 billion derivative contracts were traded. What could go wrong? Trading activity in interest rate futures and options increased in North America and Europe thanks to the higher interest rates. Trading in Asia declined due to the decrease in commodity futures in China. These contracts were worth around $570 trillion with a T. Remember, the whole system almost fell out. We had to bail out for $700 billion. Now we're talking $570 trillion. Most of the world's, keep listening, most of the world's 500 largest companies use derivatives to lower their risk. Most of the world's 500 largest companies have counterparties in derivatives. For example, so someone says, oh, Deutsche Bank goes down, it's just Deutsche Bank. No, it's not. It's every company, it's every bank. For example, a futures contract promises, here's a great example. This article is awesome. For example, a futures contract promises the delivery of raw materials at an agreed upon price. This way, the company is protected if the price rises. But if the price rises, in derivatives, every gain, there's a loser. Every winner, there's a loser. It's like anything else. So someone who wrote the contract lost, someone who accepted the contract won, and vice versa. Companies also write contracts to protect themselves from changes in interest rates and exchange rates. Absolutely, but there's a winner and a loser. Every time there's a winner and a loser. Derivatives make future cash flows more predictable for the individual writing the original derivative, yes, if the counterparty stays in business. They allow companies to forecast their earnings more accurately. Well, I don't know about that. The predictability boosts stock prices. Businessmen then need less cash on hand to cover emergencies. This is just scary. You can see the buildup of scariness. They can reinvest into more business or buy more derivatives. Most derivative trading is done by hedge funds and other investors to gain more leverage. What could go wrong with more leverage? Derivatives only require a small down payment called paying on margin. Many derivative contracts are offset or liquidated by another derivative before coming to term. These traders don't worry about having enough money to pay off the derivative if the market goes against them. If they win, they cash in. Yeah, what if they lose? Well, they just pay it off. What if they don't have the money to pay it off? They go bankrupt. And what happens to the other person holding the derivative? All of a sudden, they don't have money. And so on, and so on, and so on. The daisy chain. Now, here's where it gets good. OTC. Derivatives that are traded between two companies or traders that know each other are called over-the-counter options. They are also traded through an intermediary, usually a large bank. What does that tell you? Unregulated, not on the markets. Every derivative is different. The contract specifies different things. Oh, you have to buy this option at this location with this delivery mechanism to this vault in Switzerland on this day at this time. It's all specified in a contract that's a derivative contract. And every single one is different. And the crypto guys know, oh, we'll absorb the liquidity. Good luck. That's ridiculous. Exchanges. Now listen, this is such a important thing when we're thinking about what's going to happen in the future, as Deutsche Bank is clearly looking at going down. Crypto guys got to get a grip. Nothing is going to survive this, and there is no smooth landing. There is no absorbing derivatives. Derivatives were meant to be the weapon of mass financial destruction. That's the way it was designed back in the 90s, and there's nothing you can do about it. There's nothing Greenspan can do about it. There's nothing anybody can do about it. Exchanges, listen to this, a small percentage of the world's derivatives are traded on exchanges. These public exchanges set standardized terms and contracts. That's so important for cryptos because every crypto contract can have different language, different everything, time, place, people involved, triggers, you name it. Remember, 25 billion derivative contracts traded in 2017. These public exchanges set standardized terms. They specify premiums or discounts on the contract price. The standardization improves the liquidity of derivatives. It makes them more or less exchangeable, thus making them more useful for hedging. What could go wrong? So you've got a, quote, small percentage, and maybe this is what the crypto guys are talking about, the small percentage of derivatives that are traded on exchanges. That doesn't solve the derivative problem at all, not even close. The big monster problem is outside the exchanges and the creditworthiness of every counterparty related to that. Exchanges can also be clearinghouses, acting as the actual buyer and seller of the derivative. That always cracked me up because they don't have that much money. They don't have enough money to cover their customer losses. They don't. That's just a fact. Nobody does. The Fed does because they can print as much as they want. Will they? I don't think so. Because the Feds are the ones who wrote the Road to Ruta comic books. They're the ones who did it. They're the ones who set the bomb. The largest exchange, the CME Group, aka the Crimex, is the CME Group. It's the merger between Chicago Board of Trade and the Chicago Mercantile Exchange, also known as the CME of the Merc. It trades derivatives in all classes. Stock options are traded on the NASDAQ or the Chicago Board Options Exchange. Futures contracts traded on the Intercontinental Exchange. It acquired the New York Board of Trade in 2007. This is the ICE stuff that Bitcoin Ben's all excited about, and people in crypto, the back is going to save the world. It's going to really bring in. It's going to destroy everything. It's not going to destroy it. It's the attempt to bring all derivatives into the cryptocurrencies. It's ridiculous. It can't happen. It doesn't solve the problem of derivatives. And here's the big problem, is that most derivative contracts, the vast majority, don't have homogeneous contracts. They're not the same thing. They're all different. They can't be brought onto an exchange. They're different. They all have different terms and conditions within the paper contracts that make up the agreement. The most notorious derivatives are collateralized debt obligations. CDOs were a primary cause of the 2008 financial crisis. These bundle debt like auto loans, credit card debt, or mortgages into a security. Its value is based on the promised repayment of the loans. There are two types. Asset-backed commercial paper is based on corporate and business debt. Mortgage-backed securities is based on mortgages. When the housing market collapsed in 2006, so did the value of MBS and then ABCP. So you have interest rate swaps, credit default swaps, mortgage-backed securities. AIG went down. AIG was a big one. And it only took $300 billion to bail them out, but it's still up and running, right? And what happened to the derivatives? They're still out there. And they're still writing derivatives. It is insane. It is insane. And here's where it gets really complicated. Of all those, we don't know how many exotic derivatives are out there. According to the last article, vast majority are OTC, meaning they can't go on an exchange because they are too complicated. So I looked up exotic derivatives, and I've seen some of these when I was in banking, and it's ridiculous. Exotic derivatives are financial products with complicated underlying contracts. Derivatives are based on the value of underlying assets that can vary in complexity, allowing people to control risk by buying, selling, and trading derivative contracts. In the case of exotic derivatives, the structure of the contract is not straightforward and may be customized for a specific investor or market. This contrasts with vanilla derivatives, which have straightforward terms, and again, the vast majority are exotic. For investors, exotic derivatives create more options. People concerned with controlling and managing risk may find vanilla derivatives poorly suited or inadequate for their needs, depending on the type of risk involved. Having access to more complex contracts can allow for greater control and will also expose people to the possibility of larger profits, which means larger losses as well. There are a number of types of non-standard derivatives, as exotic derivatives are also known. These include lookbacks, baskets, knockouts, average rate derivatives. Contracts may require taking averages of the value of the underlying asset over time when the contract matures rather than going to the current market price. It can also involve other calculations when structuring these derivatives. People are careful to make sure that the contract suits their needs and does not expose them to undue risk, while buyers examine terms carefully before buying with the goal of avoiding investment mistakes. Basically, they're custom. They're customized to whichever way these creative banking people decide to write the contracts. They are non-homogeneous. They can't be bought and sold. They can't be sucked into a crypto world. They are each individually different, and they are in the trillions of dollars. Trading exotic derivatives may be tightly controlled in some regions. Regulators are often concerned about the risk to unexperienced investors. These members of the investment community may not be comfortable or familiar with advanced trading tactics and could be in danger if they purchase these derivatives and other complicated financial products. There are worries about not understanding terms or being able to control risk if an investor is not extremely familiar with the market and the terminology of contracts. Even for experienced traders, there is a risk of getting into trouble with exotic derivatives. And that's the vast majority of the derivatives. They're customized. So no, there is no soaking up the derivative liquidity in cryptocurrencies. I'm sorry, it ain't going to happen. It's impossible for it to happen. What will happen is they'll start to do it, and they'll soon discover, oh my God, this is all a credit game based on weak credits. It's got nothing to do with math, and math is the power of cryptos. So Bakkt will fail miserably. And there will be no smooth transition. Great. Here's a great example. This is an article, December 4th. So the end of December 2017, beginning of January. So this is a 1-year example of what could go wrong. Here's an article. Nexus Bank bets on fixed income equity derivatives to grow Asia sales. Natixis, I don't know how to say it, aims to boost Asian share of its corporate investment banking sales profit to more than 15% over the next couple of years as the French bank expands in areas such as fixed income and equity derivatives, its chief executive said. The region league currently accounts for roughly 13% of the bank's revenue in corporate investment banking. The biggest contributor to sales at Natixis is also interest in asset management and insurance. The bank plans to continue adding to its headcount of over 620 in Asia, its fastest growing region globally, by 10% over the next 3 years, the global CEO Laurent Mignon told Reuters in an interview. Nexus aimed to grow its investment banking business in Asia comes against the backdrop of heightened competition from Wall Street banks, so they're all doing it. Let's fast forward only 1 year later. Bloomberg. Nexus said to seek sale of Korean derivatives that blew up. French bank said to gauge interest at JP Morgan, BNP. Nexus reported losses and provisions of euros 260 million for the portfolio. Euros. $300 million. French bank that sought to grow in risky trading business is looking to sell the portfolio of complex Korean derivatives that blew up in the fourth quarter, losing almost $300 million. Great example from one article to the next. That's just 1 year later. Everybody needs to understand there is no way out of the derivative complex. It was built to implode the system. And I think sooner rather than later, and I talk about that at Road to Ruta. So check out Road to Ruta. We're on day 2 of the cleanse, feeling good. Not missing anything, it's only 1 day. But yeah, feeling good. I'm starting to get that feeling again that, hey, I remember it. I know there's going to be struggles. But the feeling of power, it really is a feeling of power when you do this cleanse thing. For me, because I eat like crap and have a long history of abusing my body, so to speak. But yeah, it's going well so far. Everybody who's out there, Amy told me there's over 200 now, over 200 people doing this, which is awesome. And I hope that all of you finish the 21 days. I know that not all of us are going to finish because it's not all that easy. The hardest thing is changing your social life, not going out partying with your friends. But by the time the Bitcoin BIM meetup comes, I'll be lean and mean and a fighting machine that you need to be as we go out there in the world and fight the battles against the bankers. So please go to Bitcoin BIM's website and find out information on the August 17th event, picnic fundraiser charity event. I will be there performing a whole bunch of songs and talking to people and hanging out, and can't wait for it. So check out Bitcoin BIM's website and make sure you're in St. Louis on August 17th. And if you want to go to the Road to Ruta mega event, I think we're over 300 now, in Vegas on October 27th, send me an email. It costs you 1 Litecoin. And Litecoin's cheap today. It's under $90, I think. It's a full day event. It's at the Cosmopolitan Hotel in Vegas. Starts around 1 or 2 o'clock. I'll get more information out to those who want to go. So if you want to go, send me an email, bix@roadtoruta.com, and I'll send you all the information and where to send your Litecoin. It's Bix Weir. I'll talk to you guys later.